So we are here back there today. Hope you're having a good day. So our topic for today is advantage advantage of forex trading. Advantage of forex trading. Why do we trade forex? You can't be going into something without you knowing the reason, without you knowing why, without you knowing how it can help you, without you understanding the principle behind it. So these are what I want us to go through today. And number one, I'll say market is global. Number two, good for beginners. Number three, round the clock market. Number four, leverage. Number five, volatility. Number six, no restriction. On directional trading. Number seven, nobody controls the market. Number eight, low transaction charges. Number nine, technology. And there's something I actually need to add to it, and this liquidity. Okay. So let's just like 10. Let's just like 10, don't worry. So within this 10, we're going to learn more. Okay. So I will start one after the other now. So I'll be explaining and be deleting them, okay? Because of space. Market is global. What do I mean by this? The market is global. What is the meaning of global? The foreign exchange market is truly expensive, with traders participating from all over the world. Everyone, they are trading in Nigeria, Ghana, Togo, Mali, Turkey, America, London, Germany, Czech Republic, Hawaii, Russia, everywhere in the world. Everyone is trading. It is a work that is being done all over the world. It is being done all over the world. No one is restricting. No one is doing this. No one is doing that. It's being global. So if you are a trader, you are actually participating in the work being done all over the world, in every part of the world. You understand? And some other factor that makes it so lucrative is that wherever you are, you can trade. You can be living in America today and decide to relocate to London tomorrow. You continue your trading career. It doesn't nothing stop you from trading wherever you are. So it's like global. It is being done all over the world. Everyone in the world is doing forex trading. So, and that makes it so beautiful, that makes it so awesome, that makes it so sweet to do. Okay, so number two now. Let's go to number two. Says good for beginners. Good for beginners. Who are the beginners? These are the newbies, the novice in the market. Now, first-time traders looking to make small investments can easily enter the forex market. One of the many advantages of forex exchange is that brokers offer a provision of demo accounts. Using this, rocket traders can test their skill in the market simulation before committing to any deals. The forex market is so simple that I would say simple when you understand the principle, okay? It's going to allow you to engage yourself, and brokers. Who are the brokers? The brokers are the one that gives chances for you, that provide your trading account for you. Don't worry, when we get there, you understand. You can actually have a demo account. A demo account is not like a real account. It's called demo because it's a place for you to practice. You can start doing forex trading now, and you go live. You cannot go live like you just want to go live. No, immediately it is not possible. You need to start from somewhere, and you need to start from a demo account, and that is why it's good. You can make practice, you can burn money, you can gain money in demo account, though you cannot withdraw your money, but at least it's a very good way to make attempt to what you are learning so far in the forex market. Number three is what? Round the clock. Round the clock. That's number three. Sorry, let me change it back to black. Okay. Given that the forex market is global, trading can take place almost continuously as long as the market is open somewhere in the world. It operates 5 days a week for 24 hours each day. And the major market opens in Australia, Sydney at 5 p.m. on Sunday, and trading ends when the US New York market closes at 5 p.m. on Friday. So we have the forex market open every time in the week, almost every time. Because okay, let me just type this out for you so that you can actually read that yourself. The major market opens in Australia, Sydney at 5 p.m. on Sunday, and trading ends when the US New York market closes at 5 p.m. on Friday. Because I want us to actually be able to see what I'm typing, so I'll make it this way. So once you start on Monday, let's just say Monday or Sunday evening, because depending on where you are in the world, okay, with the fact that we know that some are in the morning while some are in the night at the same time, and some are in the afternoon. So you have to check the time that you are trading. You have to check your own personal country time, and that this will subject you to know when you are supposed to go into the forex market, when you need to trade, when you need to come into the market, and when you need to do a lot of sort of things that have to do with the market. You can't just wake up at the middle of the night and say, okay, I want to trade. No. The New York people have to wake up at the middle of the night. They have to be up to trade the London section. Why some other part too need to wake up at their own midnight to trade New York section as well. It all works in a diverse way. But the market opens every time. And we have some trading actually that are like volatility index. Volatility index opens every time. No weekend. There is no weekend. The reason why currency pairs only open from Monday to Friday is because it has to deal with the bank transaction, and the bank doesn't open on weekend. Only one country that I know that opens on weekend is Canada, but that still doesn't give us any it doesn't give us any effect on the forex market, because you can't trade it as just CAD. You can only trade the US dollars, US 30, US 50. You understand? So it doesn't mean like maybe one boss is going to tell you there's a time you have to wake up to the hobbies. It's all yours. You can do whatever you like. Number four is leverage. Number four is leverage. Foreign exchange brokers allow retail traders, who are the retail traders? It is me, it is you in the forex market that we are looking forward to having profit, to making profit in the market. That is the reason why we are in the forex market. We want to make profit. We want to earn money. That's the reason why we are here. So they said foreign exchange brokers allow retail traders to borrow against a small amount of capital, thereby offering a chance to open a high position. The amount of money you raise from leverage is generally represented as a ratio. For example, 1 ratio 30. It means that the leverage is like 30 times of what you actually invested in the market. Like now, let's say maybe you place a trade and your ratio to reward ratio is that maybe like 2, and then you invested $10 in the market. I'm just saying, and you made that times 2, that's like this 2 now. That's $20. So that means you can invest money in the forex market and then trade it to earn more. So that is about that. Let's go to number 5. I hope you are understanding. Number 5 is what? Volatility. Number 5 is volatility. It says geopolitics, economic stability, politics, natural calamities, and trade deals are among a long list of forces that influences the market. Yes, a lot of things come together to bring in the market. Like now, the way there is war at the moment in Russia and Ukraine, yeah, it's bringing some volatility with gold. Yes, pumping and dumping. So a small development in any of these translate into a major shift in the market. You understand? So let me just bring in the causes of major shift in the market. Causes of major shift in the market. You have the one, geopolitics. Geopolitics. 2, sorry. Geopolitics, we have economy. Number 3, we have stability. Number 4, we have policies. Number 5, we have natural calamities. Number 6, and let me just stop there, no problem. So some of these things bring volatility in the market. They bring shift, they bring an effect. When it happens, there's going to be an effect in the market. It's going to bring a major thing to happen in the market. Maybe like the market going up and up and up. It can actually cause like the market going just up and up and up and up, or it can actually just make the market to crash. Some of these things can actually make the market to really crash. So these are the major things in the market. And then they say this sensitivity of a market is called its volatility. Whenever all these things happens and then there is a cause of it in the market, it brings in volatility in the market. Yes, it brings in volatility. It makes there to be let me just bring an example like this. Assuming price has been going like this, on a normal way, then there is a large volatility. It crashes down, comes back up again, and then still goes up. That's like there is something happening in the market. It's not supposed to, like, do you understand? On a normal day, like maybe it's not supposed to be going just so massive and coming back so massive. So it's actually just being like some kind of, it's going to bring some kind of volatility in the market. So, and then we say, however, if the value are affected adversely, trader can suffer significant losses. Since volatility cannot be avoided altogether, you should go about having strategies to deal with volatile markets. So, in this kind of situation, traders can actually be lucky by, or maybe you put a buy position and the market actually just, the market bought, you long it and it longed. Fortunately, or maybe you actually know the principle that you are already bringing into the market. Probably maybe you've done your analysis before and then it all goes probably the way it's supposed to go, you win. But if the volatility comes to the market, or like some kind of spikes, happen in the market and it doesn't go your way, that's like a loss. Do you understand me now? So but you have to have a strategy to deal with the market. Yes, and these are part of the things we are actually trying to learn. Strategies: how will you not lose in the market? How will you win? These are some of the things that we need to take good notice of. Okay. So number 6, they said there is no restriction. Number 6, there is no restrictions on the market. No restriction on directional trading or anything, but there's no restriction. So they say, unlike the stock market, the foreign exchange market does not have any restriction or directional trading. Since traders are always either buying or selling a currency according to the state of the market, you can easily go long or sell depending on your prediction of changing in the value. So now let's say now your own now, what buyer traders can actually do. Traders can either buy or sell, right? Traders can either buy or sell. This is one thing you can either do in the market. Is either you buy or you sell. So there is no other way around. And I think I told you before that buying the market also mean long. Why sell in the market? Short. Buy mean long and sell means to short in the market. So you can do whatever you want in the market. It all depends on you. Maybe now you feel like this is supposed to long, and you place your buy here. Let's just say maybe let's say there is the market, and then you actually like just bought from here. So that means it went as a buying trade. That's what you feel, right? Maybe you've done your analysis and you felt that the market is supposed to buy, and either way around, maybe you felt like the market is supposed to sell in the market and then you went short in the market. So that's still like a choice of yours. Nobody's going to query you for whatever you do in the market. All depends on you. Buy or long, or you sell or short. So it all depends on you and what you feel like you need to do in the forex market. So there is no restriction on that. There is no restriction. So that's one of the benefits on the market. I hope you are enjoying my lecture so far. Please try to decode everything and understand them very well. Okay, so now the next one is low transaction charges. Number 7, low transaction charges. Yes, a small capital sum is enough to start online forex trading without any major cost of conducting transaction. The cost of transaction largely comprises the broker's fee, which he earns from spread. There's something we actually call spread. Let me type it here. Some don't actually know the meaning of spread. Okay, I'll just type it here. The spread is measured in pips or point in percentage, which is different between the ask price and the bid. I'd like to type it out for you. The spread is measured is measured in pips or points in percentage, which is the difference between the ask price and the bid price. So these are they actually like how do I put it? Like the time you buy or the time you sell in the market, these are the ask and the sell and the bid price. So this spread is what goes to your broker. Like now, maybe the market is, let me make a good example for you. Maybe the market is actually going to sell, okay? And then you place your sell here. Let's say you place your sell here. Let's assume it was a breakout or something. So you place a sell here, the spread can actually be like this, like a pip or something, which is going to be for your broker. You see the distance within this red line and the green line is going to be the one going to your broker, your profit. So regardless of whatever you make in the market, your broker is going to have a gain out of your money, which is like a charges. Okay, it's like a charges. It's different from withdrawal charges or funding charges. No, but at the moment that you are trading, there is going to be a charges in the market that is going to be leveled on you as a trader, and this is always like very very small. It's not as if maybe is a very big thing. And sorry, I'm just saying this is actually number 8, guys. We are not going backward, we're going forward. Okay, so let me delete this. And the next one is number 9, which is technology. Yes, technology. Since the market is relatively new, among the advantage of forex exchange is that its participants have embraced technology widely. There are plenty of software and mobile applications that facilitate trade in real time from around the world. The technology have allowed, like now you want to trade forex markets, you actually just need a laptop and a phone, right? So, and then some technologies actually allow us to connect with other traders, knowing let me just like indicators now. Indicators will allow you to know some certain things. Let me bring in one let me just say moving average. Okay, let's assume like moving average now. I applied it to the market. Though the market is closed, it might not actually be effective, but these indicators actually tells us what the market is doing at a particular point in time. Like what are the things in the market. They try to like give us like an expo to know the buying rate, the selling rate, but no indicator will actually tell you, or no technology in the market will tell you where the market is going. They can only try to signify to you or give you an hint. Okay, because you still need your personal confirmation as well. So, and the last but not the least is the liquidity, which is going to be our last advantage of forex trading. There are a lot of them, but these are like the very essential ones that I want us to have understanding about. Okay, so they said due to the large volume of trading activity that occurs around the clock in the forex market, it is considered the most liquid market in the world. Yes, the forex market is the most liquid market in the world. Liquid. Yes, the most liquid market in the world is the forex market. So liquidity refers to the ability to assets to be bought and sold with little effect on their value. In the case of forex market, liquidity allows you to trade with minimal risk. You can trade with so very very little risk, very little risk, because you don't just go into the forex market like putting in like a lot of your money without you even understanding how it works. No, it doesn't work that way. You can trade with, as the lowest lot size in the market. And what is the lot size? It's like the frequency of how you want your money to actually go up or go down. Like it's just like a frequency. Like now, one lot size is actually big. If you watch my previous video about pips calculation, you will understand more. Imagine someone that use 1 pip and someone that use 0.1, like micro lot, and someone that use mini lot, and then someone that use micro lot, 0.01. So there's a difference in what you're going to earn or gain in the market. Please take your time to watch this video very well and understand everything that I've said so far. Thank you very much. Thank you for your time. Bless.